let's talk about some places that I see or that we see as a team in our research, some places to put some money, kind of take some lessons learned from 2023. And I'm going to start out with the psychological aspect of investing, because BlackRock recently put out some really, really good slides that take some historical context on the S&P 500. You get years like 2022 when the S&P is down nearly 20%, and folks don't participate in a lot of that downside. And oh, Chris, thank you. Don't participate in that downside, and then they don't get the full upside of the next year. But there's a lot more under the surface, and I want to start with this slide right here. Win more by losing less. And I think this is a really important concept for everybody to understand. This is if you started on October 9th of 2007, and we're going to end it on December 31st of 2022. And we're just going to look at the S&P 500 index through one of the biggest and longest bull markets that we've seen in a long time, right? 2009, we're going to go through the Great Recession, and in 2009 and beyond, and just talking about losing less on the downside and what that can really mean for your portfolio. And most of you that are potentially in retirement, doing retirement distributions, really take note of this, because when you're taking distributions on a monthly or annual basis, because you're required to do so by the IRS and your 403B or your 457 or your IRA, it can be really, really detrimental, because it's the direct opposite or the antithesis of dollar cost averaging into a portfolio. You are dollar cost averaging out of a portfolio, and it really can rip portfolios apart if you don't protect your downside. So in this simple example, if you had 100,000 and you invested it in two different scenarios, one just the S&P 500, no fees, no expenses, just whatever the S&P 500 gets you. And then you look to the right and you get half of the S&P on the upside, but you only get half of the S&P on the downside. Think of a properly diversified portfolio, or think of a portfolio that's properly hedged, maybe selling covered call options and complementing that with treasuries, which is what we do in our business. But on the right side, you're only getting half of the upside and half of the downside. And because you lost less on the downside, again, you didn't get nearly as much on the upside. And you can see the numbers there, starting with a 55% loss in the S&P to the nadir of March 9th of 2009. You only went down 31% in the scenario on the right. And then in the subsequent rally, on the left side, you did 528%. On the right side, you only did 301. And then you can follow through the numbers there. But the bottom line is, roughly, 15 years later, on December 31st, 2022, you had the exact same amount, or just about the exact same amount in the portfolio, with 50% less risk and less volatility. And if you are in a point in your life where you are taking distributions from your portfolio to supplement your income, you have to understand how vitally important it is that you do not participate in the downside. And this is the reason why. If you just look simply here at these numbers, what this is, in the yellow is the return needed to break even, and the red is the investment loss. And in 2022, towards the end of the year, I did a presentation. You can go back and look at some of them, of some of those high-flying tech stocks that we all wish we owned last year, the Magnificent Seven. But what their losses were in 2022, some of you may remember that Meta was down 75%. Amazon was down 50. So let's just take a look here. Amazon was down 50, excuse me, Google was down 50. If you take a look here and you go down 50%, simple numbers tell you need 100% return just to get back to even. If you go down 30%, you need 43% just to get back to even, right? And if, God forbid, a Meta situation, you own a stock that goes down 70%, you need 233% just to get back to even. So I think it's important to understand the value of losing less on the downside. And what a perfect time to discuss that, because here we are at all-time highs in the S&P 500, all-time highs in the Dow, and I believe the NASDAQ is approaching an all-time high. By the way, does anyone know out there, if you want to put it in the chat, what the first index to reach an all-time high was? Most recently, by the way. Does anyone want to venture a guess? Kind of just gave you a hint there. Well, it was the Dow. And the reason it was the Dow is because the Dow in 2022 only lost 9%, whereas the S&P was down 20 and the NASDAQ was down 35. So kind of supporting this concept I have here on the charts from BlackRock. is that it's really, really important, particularly in your retirement where you're not continuing to put money into your portfolios to protect your downside. So diversification can feel really disappointing, and I really like this slide from BlackRock. So if we go back to 2000, right, and you got your S&P 500 on the left and the diversified portfolio on the right, and you can see 2000 to 2002, the S&P is down 40%, and a diversified portfolio, you lost money, but you lost less on the downside. And then 2003, 2007, you get a big rally if you have a diversified portfolio. You're up 91 and a half, and the S&P is up 82. Why is that? Because commodities, and in particular international, worked a lot better than the S&P 500. And so this is the one time you'd be happy. Diversification worked. And in 2008, the S&P's down 37 and you're down 28%. Well, I lost money. Diversification didn't work, right? And then in a subsequent 10-year rally, 2009 to 2019, you underperformed the S&P 500 by 120%. And you say, well, I didn't make as much. And then the first quarter of, the pandemic quarter of 2020 happens and you lose, 20% less than the S&P 500. And again, I lost money, diversification didn't work, right? And then quarter 2020, quarter two, 2020 through the end of the 2021 rise, you made roughly half of the S&P 500. And again, you're disappointed. 2022, you're down, not quite as much, but you still lost money. And in 2023, with a real big rally in the S&P, you didn't do nearly as much. But had you stayed in the diversified, less risky, less downside portfolio for this 23-year time period, the actual end result is that your results would have been better than the S&P 500. And I thought that was a really interesting slide. And obviously, we could take different time periods. You could probably get some different numbers. But the bottom line is, in retirement, you're taking retirement distributions. You have to protect your downside in a portfolio. So getting to the markets, and again, this presentation was about where we see opportunities and what we see from a standpoint of risk and return. What has caused this, incredibly volatile 2022, 2022 obviously historic because not only did stocks not work, but bonds didn't work, nothing worked, right? Everything was down significantly. Well, what caused that? Right here, simple enough, this chart from JP Morgan, you could see rate hikes collectively from global central banks, and then rate cuts, and then net policy moves in the middle there, or excuse me, at the black line. You could see historically going back to 1990, we've never seen a tightening cycle like this ever before, or at least in the last 30 plus years. And so that was the reason, or what caused the significant down market in 2022. And the pause of this, which we have seen recently, is responsible for the reversal and the great year we had in 2023. So let's talk about the market and where it is right now. And of course, I always do the stuff quarterly. I don't do it by the day because we like to take a step back and look at the bigger picture. But right now we're approaching all-time highs or at all-time highs in the S&P 500. It just broke through the other day. We're up at 4850. I actually haven't looked today to see exactly where we're at. But one of the things that I would caution you on, and I think a lot of people get very, very excited about when the S&P 500's all-time highs, we look at our portfolios and we go, wow, portfolios that are all-time high, or they're approaching an all-time high, and I got a lot more money than I did a year ago in my portfolio, and that's great. But these are the metrics we look at, right? So this is a 30-year average, the dashed line, green line in the middle. The 30-year average of the S&P 500 trades at a forward price to earnings ratio of 16.59%. Okay, a little bit higher over the last 10 years, simply because interest rates have been extremely low. But when we get to a first standard deviation of valuation in the S&P 500, that's when we get pretty skittish about buying new stocks, because this is what we would call overvalued. One standard deviation away from the 30-year average. And right now, or as of December 31st, 2023, the S&P 500 was trading at 19.5 times. I believe today it's much closer to 20. So we're probably at that one standard deviation. So we collectively, our research internally at Sierra Pacific, and the research we use from JP Morgan and BlackRock and Wells Fargo Investment Institute, is telling us that stocks right now are overvalued. It is probably not the time to be buying stocks. One of the big drivers of the stock market in 2022, if you have a properly diversified portfolio across all asset classes, and you don't just own 7 or 10 tech stocks, You can see here maybe why your returns were muted compared to the S&P 500. And so again, the S&P 500 did roughly 26% last year, but the equal weighted S&P 500, meaning we give an equal weight to all 500 companies, we don't market weight them. The equal weighted S&P 500 returned about 13% last year, right? So that's half of the index. And why did that occur? Well, it's right there in the left chart. The top 10 the performance of the top 10 stocks in the S&P 500 gave us 62% of the overall return of the S&P 500, which is pretty insane if you think about it. The weight of the top 10 stocks, top right chart, in the S&P 500 is at an all-time high since even the mid-90s. Even in the dot-com bubble, the top 10 stocks did not account for 1/3 of the S&P 500. It's a very concentrated and narrow market, and you can see the earnings contribution of the top 10 is significantly lower than their market capitalization. That's a disconnect that we think, is going to play out at some point, and markets can stay overvalued for a long time. Stocks can continue to be strong and run due to momentum, due to large money managers chasing performance. They call it window dressing in our industry. As you get towards the ending of the first quarter, the strongest stocks will tend to be bought. And that's because every money manager that owns a mutual fund or a Fidelity fund or something, they want all those really super strong stocks showing up in their portfolio as top holdings, right? So that's called window dressing. You see that a lot as we get close to the end of the quarter. But if you lift up the hood and you take a look at all stocks, right? Not just the strongest 8 or 10 tech stocks. This is the percentage of NASDAQ constituents that are down 50% or more from all-time highs. We're still close to 50% of stocks in the NASDAQ that are down 50% or more from the price highs. Think of Beyond Meat, think of Affirmed. There's a bunch of tech stocks out there that did really, really well in 2021. And then as tightening came in, they just have never really recovered. So what about bonds? Because, last year, or not last year, excuse me, 2022 was obviously historically bad for bonds. So what do we think about the relative valuation of bonds? Well, here are the inter-year declines versus calendar returns. Excuse me, I think I have, this is the S&P, sorry. It looks like, here's the chart I was looking for. So this is a Bloomberg aggregate, inter-year decline versus calendar returns. Right, so last year, 2023, we did about 6% despite interest rates continuing to rise. And now we believe interest rates are at a point that make bonds very attractive to enter into. And in particular, if you look at the shorter end of the yield curve and in the treasury zone, you could still get 5.25% or higher on a 1, 3, and up to 6-month treasury bill. These are very attractive returns, especially if you're a California resident. We've been rolling a ton of treasury bills for our clients. I know a lot of people are predicting interest rates to come down significantly over the next several months, but we're not going to see that until we see a significant degradation in the overall economy. And that would be the reason that the Fed would begin to lower interest rates. Let me point you to a place that maybe you haven't looked if you're looking again for investments that are very attractive. For those of you in higher income brackets, California municipal bonds right now, the right ones, investment grade municipal bonds, have very, very attractive tax equivalent yields. And what is simply a tax equivalent yield? It just means what you would have to make in a fully taxable bond, because if you own a California muni bond and you're a California resident, you don't pay income tax most likely at federal or state. So what is the equivalent yield that you're getting if you are in a higher tax bracket? And for most of you that are in a higher tax bracket, federal and state, some of the tax equivalent yields are 7% or higher for investment grade municipal bonds. We've been putting a lot of ladders together in investment grade municipal bonds because of the security of the underlying bond and because of the tax efficiency of the bonds. If you certainly have more questions, you can reach out to me on that. But that's someplace I would point you to look at, because I think that's a place you certainly want to be considering in the current market environment. What's another thing you want to possibly consider? This is a longer term dynamic between the MSCI EFA, which is Europe, Asia, Far East, which is an international index that excludes the US, versus the USA index, which is going to be represented mostly by the S&P 500. Okay. So you go through these different cycles where EFA outperforms and the US outperforms. Well, we just went through this longest cycle ever in history, 14.2 years, where the US has significantly outperformed investments outside of the US, largely because of a strengthening dollar, which is a huge headwind for international investments if you're a US investor. Now, if you, on the other hand, are looking for opportunities in your portfolio and places to potentially deploy capital, if you've had large gains and certain stocks and you want to take some of that risk off the table, you may want to look at some ETFs, some international, some EFA type ETFs that give you broad exposure to markets overseas. If we get a depreciating dollar, which we would have if the Fed starts to lower the interest rates on Fed funds, then certainly we could see a significant tailwind instead of a headwind for international investments. All right. So moving along, now that we've discussed stocks and bonds, what about a recession and all the recession talk? Well, here's our favorite leading indicator in the recession space. This is the 10-year 3-month yield curve. So we're comparing the yield on the 3-month Treasury bill to the yield on the 10-year Treasury note. And what we're doing is comparing those two, and that zero line that goes to the middle. A normal yield curve means that shorter term rates will pay less interest than longer term rates. It makes sense intuitively if you think about it. I'm going to lend my money to you for a month, or or 3 months. I'm going to charge a certain interest rate, but I'm going to lend you money for 10 years. I'm probably going to charge you a higher interest rate because of the lack of other opportunities for the next 10 year, whereas 3 months. Well, right now, that's inverted. It's the opposite way you'd want to think about it. The 3-month yield is significantly higher than the 10-year yield. I think the 3-month is somewhere in the mid 5 range, and the 10-year is more like 4.5. That usually predates a recession. And the lead time on that tends to be about 18 months. The yield curve first inverted late 2021. So we are getting very, very close to that actual time. Here's the New York Fed's probability of a recession model. And you can see here, the probability of a recession right now is actually significantly higher than it was during the Great Recession or predating the Great Recession. So does that mean we're definitely going to have a recession? No, I think it's hard to say we're definitely going to have a recession. We're not going to have a recession. That's always dependent on, certain things that the Fed does. Obviously, we are in election season. Not good for a president, an incumbent president anyhow, to be in a recession during an election cycle. So I would think that there are going to be a lot of things done to prevent any type of recession, but you never know. And again, these are the leading indicators that we look at to determine, are we going to go there or not? And right now, this model says it's a high probability. Now, what type of recession do we expect? Because the probability is higher that it would be significantly worse than the Great Recession? Absolutely not. Because the consumer is so strong still, we would expect a mild to a moderate type recession if we do have one, and that's a big if. So what are the generational issues that we are fighting that, if we look longer term, could affect slower growth in the US? Well, according to Bloomberg, here are the top retirement worries, right, for the baby boomer generation, right? Inflation lessening the value of assets. It's the highest one. Major market downturn, shrinking assets, health costs, straining savings, taxes, reducing retirement savings, and then not being able to afford desired lifestyle. And here's the aging population. This is, of course, the US Census data. The number of people age 65 and older in the US is set to increase, and significantly. We're going here from, roughly 45, 48 million to, well into 70 million people. And what are these people doing? They're no longer working. So they're no longer producing goods and services in the overall economy, and they become a significantly larger portion of the overall population. At 70, 75 million, that makes 1/5 of the United States population in full retirement, right? Or near full retirement. And so you have a lot smaller, or you have a significantly smaller working base, which could lead to lower productivity and lower growth for the United States over the coming years. So again, going back to what are where are places to allocate money? What are things that we should think about? If you've been over concentrated, it's one of the funniest things we talk about, and I would say funniest, but one of the biggest things we discuss in our meetings that we do with clients and when we review is 60/40 was out in 2022. Diversification did not do us what it has done in the past. But I want to be clear, and we look at the 60/40 there in the center middle, it's on the bottom. If we look there at a 60/40 traditional portfolio, if we really wanted to protect ourselves more, we would take a chunk of the equity off the table and a chunk of the bond off the table, and we would allocate a significant portion to alternative investments. What do I mean by alternative investments? Commodity exposure, maybe some hedge fund exposure, maybe some hedge strategies like running covered calls, maybe some, depending on your net worth, some, potentially some private equity or some other type of investments that don't necessarily align with traditional stock and bond. And you can see there, if we have, annualized volatility on the x-axis or the bottom, which is just simply a measure of risk, and we have annual returns on the y-axis, you can see you actually bring your risk back and your return up simply by lowering your stock and bond exposure and adding alternative investments. Another caution I have, especially when we're here at all-time highs, is do not chase yesterday's winner. If you just look at all these times when we were in such a concentrated market, I think it's important to not chase the NVIDIAs, to not chase the Googles, to not chase, the Microsofts, the stocks that did so well last year. That is a common mistake, a common psychological mistake with investors. It's called anchoring, and people anchor to past returns. And that's one of the biggest fallacies in investing, is something you should think about hard when you're looking at rebalancing your portfolio, particularly if you're in retirement. And then finally, I'll end with this, and I think this is exactly what I just said in the last slide, but let's look at it from a standpoint of history. If we look at 1980, right, here are the top 10 stocks, our top 10 largest companies by market capitalization in the world, right? You had IBM, AT&T, Exxon, Standard Oil, Schlumberger, Shell, Mobil, Atlantic Richfield, General Electric, and Eastman Kodak. And I would ask you, how many of those stocks 20 years later in 2000 were still in the top 10? And you would see, I think it's just General Electric, if I'm correct. Nope, ExxonMobil was there as well. So 2 out of 10 of those top market capitalization stocks managed to make it 20 years later. Now go 20 years later to 2021, and how many of those top 10 stocks in 2021, 21 years later, are part of the top 10, and you'll find one, Microsoft, right? But how many of those from 1980, 41 years later, are in the top 10, and you'll find 0? And that's part of the US economy, creative destruction, innovation, entrepreneurship. And what it does is companies that are on top today, more likely than not, will not be on top, 10, 20 years from now. So I leave you with that. And again, that's, don't anchor your, what you invest in or what you want to invest in based on what worked yesterday. If I can summarize the presentation today, where are the opportunities as we sit here at the beginning of 2024? And again, I don't know any of except for those of you on here that are clients, I'm not familiar with, your investment goals. So I want to be clear, this is not an investment recommendation, but I think it's important to understand what worked all through 2023 is highly likely not going to work in 2024. It doesn't mean it's going to, falter or go down significantly in value, but I think you need to be aware that things change. Just like in 2022, the things that worked, like commodities, didn't work in 2023 nearly as well as the things that were the big losers in 2023. So think about that as you reallocate. If I had recommendations on the fixed income side, I would certainly, with whomever you work with, or you're welcome to call us for some advice specific to your own plan, I would look heavily at short-term treasuries, maybe even going a little further out on the treasury yield curve, depending on your tax situation. I think if you're a California resident in a high income bracket, California municipals, the right ones, are very attractive right now. And I think on the equity side, I would certainly be looking at shoring up some of my big winners from 2023 and taking some profits, and looking at possibly adding some international investments, or at a minimum, some alternatives. I think a hedging process is a really, really good way to go about that. We really like writing covered calls against highly appreciated positions to save clients from adding to their tax burden. But those are things I would certainly consider. And with that, I will conclude the presentation and open up the chat. And any questions, if you want to unmute yourself. Wayne Johnson, everyone. Any winners in 2024 energy oil sector stocks? Yeah, I refrain from talking about specific stocks here because as a certified financial planner, I have a fiduciary duty on any recommendation I make, and I don't want to be any recommendation to be construed as a personal recommendation. So sorry, Wayne, if you want to talk offline, I could certainly try to point you in a direction that we think is a good place. Sector energy oil. Yeah, energy is certainly a late cycle sector. I think dividend yields are attractive. They had a significant run up in 2022. If the economy starts to falter, they could be attractive from the standpoint that they are very defensive. But I can't say that they would be at the top of my list right now. Additionally, and some of you may find this funny, some may not, but traditionally oil companies do well when a Democrat is in the office. I know that sounds counterintuitive, but it's actually true. And companies that you would maybe see are more blue, like tech side companies, actually do better when Republicans in office. So oil, if there is a change in the White House, may struggle. Barbara, go ahead. You need to unmute yourself. Here, I'm going to unmute you.
Thank you for waiting while I unmuted. Ryan, another great presentation. Thank you so much.
Thank you, Barbara.
Ryan, I'm wondering if you have, and maybe this is not a question that there isn't the right an answer to, but you mentioned something about covered calls when you have appreciated.
Yeah, highly appreciated stock. Yep.
Yeah, highly appreciated. Do you have a guideline about how to determine what you would consider highly appreciated and worthy of that strategy?
Yeah, that's a great question, Barbara. So it depends on what your goal is. So we often, because I'm very close to the Bay Area, we're two-hour drive from the Bay Area, and certainly in Incline Village, where I spend most of my time at our office there, we get walk-ins all the time that are executives or folks that have highly appreciated stock that maybe doesn't pay a dividend because it's a tech stock, or maybe it does pay a dividend, but it's 1% or 2%, and that's they want to raise that income.
Mm-hmm.
That's a place where you'd maybe want to do covered calls. Another one, quite frankly, is if you're selling covered calls against an underlying position, it's a tax efficient strategy in the fact that you have to be willing to give up a little bit of your upside to protect a significant portion of your downside. But if you do have upside in the underlying stock, you're going to be buying the calls back at a loss, which creates a short-term capital loss that you can use against capital gains to reduce your tax bill, which is obviously very important here in California. If, on the other hand, the stock goes down precipitously, which, we ran a covered call strategy in 2022 on stocks that we had as underlying stocks. The stock portfolio itself was not quite in line with the S&P being down 20%. It was about 18% down. But because of the overlay of the covered calls, the strategy was only down 9%. So it provided a 50% buffer on the downside. Conversely, when the S&P was up 26 this year, that strategy was only up 14 or 15. But I would reference my slides at the beginning about losing less on the downside and being willing to accept less on the upside. And in the long run, particularly if we love that strategy actually in retirement accounts because it covers R&Ds pretty easily, but it's also a great strategy in taxable accounts because of the tax efficiency. Thank you for your question. And Barbara, I have a whole separate presentation on covered calls and the strategy we use. If you want me to send you that, just send me an email and remind me. I think you'd like.
Yes, I would like to see that, Ryan. I'm sorry I missed it when you gave it. So thank you so much.
Actually, I just updated it for last quarter. So just shoot me an email. I know you have my email address, and I will send it right over to you to read.
Thank you very much.
Absolutely, Barbara. Good to see you. Happy New Year.
Happy New Year. And thanks again. These are always great, Ryan. Thank you.
Good. Thank you. Thank you, Barbara. I appreciate that. Anyone else have a question or something they'd like? Again, the chat box is open there. Right here on the screen, we have my email. Take it down if you have any questions. I'm more than happy. You certainly don't have to work with us for me to answer questions. I know many of you do work with us, many of you do not, and I treat it all the same. I love UCSD. You guys have been my family for the better part of a decade and a half. Vanya, you've done a great job taking over for the Suzanne, and I hope she's doing well. I haven't heard from her in a while, but thank you again, everyone. I'm looking forward to 2024. If I could just make a plug real quick, next month I'm going to cover. I think it's important to talk about annuities for people that are very, very conservative and want some guaranteed income and want to transfer risk away. So I'm going to kind of do an annuity 101 to see, if we can educate a little bit on that so people understand that a little bit better. And then in March, I'm going to try to do something I've never done before, which I think will be very interesting, is I'm going to try to cover the AI topic. I've got a couple white papers that I have that are really, really good. And, I know there's people out there that say, oh, AI is going to kill my job. Oh, AI is going to do this. AI is going to do that. I'm going to try to present to you in March how AI is going to be transformative in a positive way for us. And we're going to get further down AI into deep learning and some of the other things, facial recognition, just to give you an idea, doctor psychology appointments using AI to read people's faces to try to determine things that are psychologically going on. Some of the stuff is absolutely fascinating. I think it'll be a great time, a little diversion from just the markets to talk about the future of technology and the things that are so interesting in our world. So with that being said, thank you everyone for joining today. If you have any questions that you'd like me to answer, my email's right up there. Happy New Year, everyone, and off to a great 2024. Thank you, Donna. Vanya, thank you. I'm going to log off. Anyone can reach me via my email. Take care, everyone.
Thank you so much, Ryan. Goodbye.